everyone, welcome to another exciting and partly entertaining episode of Ladies Talking Business. Today I have an expert in the field of stocks who will be helping you really understand what the stock market is about and how it works. For those of you who do not know, the stock market is kind of a barometer which helps measure the happenings in the economy of your country. The stock market, as you may also know, can be quite volatile. For example, in 2008, we had issues where we had like global recession, and then we saw the stocks really crumble. In the studio to talk about the stock market with me today is Akeem Oyewale, the CEO, Stanbic IBTC Nominee Limited. We'll be back in a moment, guys. Welcome back. Thank you for joining me in the studio, Mr. Akeem.
Thank you, Irene.
Let's start from the grassroots. What exactly is the stock market about? Because some people are just lost when they hear about the stock market.
Okay. Thank you very much once again, Irene, and thanks for having me here. The stock market is just like the name goes, stock market. So you buy and sell in the stock market. Now, what do you buy and what do you sell in the stock market? You buy equities. You buy fixed income securities, bonds, ETFs and the like. Now, what we're going to be talking about today largely will be on stocks. What are stocks? Stocks are equities of companies. Ownership of a company is called a stock. Okay, so a market where you trade your ownership, you sell off your ownership, and where you buy your ownership of a stock is called the stock market.
So basically, when I talk about a company A, for example, I'm not solely the owner of that company because I am selling off bits and pieces of my company. So I want to buy stocks of, say, how many units, say 5 or 10 units. That means I've taken a position. So I can say I'm a shareholder in a particular company, right? Oh, interesting. How do people start investing in the stock market if, for example, they want to start investing in the stock market?
There are various ways of starting. I mean, the basic way or the way we will advise people to start is to start by investing in what we call a mutual fund. Now, what is a mutual fund? A mutual fund is an instrument where we pull together resources from many people. So 10 people, 100 people, 1,000 people, they all bring in 1 naira, 1,000 naira, 2,000 naira, 5,000 naira, and you be an investor in a mutual fund. Now, that mutual fund is going to be managed by a fund manager who will in turn now buy stocks at the stock exchange for you. Now, the reason for going through a mutual fund is that you may not have all the knowledge that is required to buy or sell shares in the stock market. But as you grow in knowledge, you can decide to now buy a company stock directly yourself. But when you are starting off, it's just best and safe if you could just put your money, 5,000 naira, with a fund manager who will buy stocks for you through a mutual fund.
Okay, so I mean, I visit the stock exchange very frequently, and I see a lot of stockbrokers on the trading floor. Are they one of the people by which you can buy these stocks in form of the mutual funds?
Yes. I mean, the stock exchange is going through a scheme right now where even stockbrokers can sell mutual funds. At the moment...
So it's not just from the banks?
Not only the banks. In fact, the banks rarely do sell, but you have asset management companies. So you have the likes of Stanbic IBTC Asset Management, Vertiva Capital Management, you have ARM. These are fund management companies that are regulated by the Securities and Exchange Commission. So they are allowed to sell mutual funds which have been licensed. So any investor could go to any of these companies and buy their mutual funds. They, on their own, will now go to the stock exchange and buy stocks for you. But as you become an HNI, you have more money, you have 100,000, you have 50,000, you have 1 million naira, and you are able to go through some financial literacy training yourself, then you can now approach a stockbroker and tell them, I want to buy stocks in a particular industry. They can speak with you, make an assessment of your risk profile, and advise you on which stocks to buy. Yeah, but when you do not have the knowledge or when you do not have the time, the best thing for you to do is to just go to a fund manager and buy a mutual fund. You are still a part owner in the companies that the mutual funds will have bought. Just as your name will not be appearing, it's the mutual fund's name that will be appearing. but you get all the benefits. When they pay dividends, when they do bonus issues, when they do anything, corporate actions, you will be a beneficiary of that.
The ways in which you get your profits or make money from buying stocks. Okay, I know that we have different kinds of stocks. We have the common stocks, we have preferred stocks, exchange-traded products. Kindly shed more light on this.
Okay, so the common stock is the ordinary shares of companies. You know, so a company like First Bank of Nigeria Holdings, you know, we may have will have listed shares. Okay, so that is what is called common stock. So if you want to be an holder, an investor in FBN Holdings, you now buy the shares of FBN. Okay, so that is common stock. Now, there are some companies that issue what we call preference shares. Some issue debentures. These are all means of raising capital in the capital market, you know, and they have different rights. But the most common one for a beginner is just to be able to buy common stocks or ordinary shares of a company.
What about the exchange-traded products? How does it work?
Exchange-traded products are like mutual funds, but instead of you going to buy this mutual funds in the market or through the fund manager, you can buy through your stockbroker, and it is traded on the floor, which means you can buy and sell on the floor. Now, exchange-traded funds are a bit more technical because they have particular purposes. You know, so some track particular indexes, some are for, you could have a gold ETF, you could have an NSE 30 ETF,
NSE 50.
NSE 50 ETF, a pension ETF. You can create any type of exchange-traded fund with a particular goal in mind. So any investor that wants to track that top 30 stocks just needs to buy the ETF. And the ETF are usually listed and tradable on the stock exchange. So it's more like an advanced version of mutual funds. So instead of you buying mutual funds that are listed on what we call memorandum sections of the stock exchange, you can buy an
picking
exchange
from different sectors and then putting them like
in
putting
basket.
in a basket pretty much.
Absolutely.
Okay.
So they put all these stocks in the basket, they tell you what they are trying to achieve, then you can now buy that basket and you can trade it when you need liquidity or buy when you have money to invest. So
from experience, would you say that that's an easier and more assured way of making money compared to when you're just buying single stocks from
in the capital market or in the stock market, we generally give a warning, which is that past performance is not an indication of future performance. So we try not to give you an assurance that by investing in ABC, you're going to get ABC return. No.
Because their financial reports, maybe last quarter was very good, does not mean that
next quarter will be good. There are a lot of variables that determine how a company performs. You have the macroeconomic variables. You have the specific industry variables. You have the intricate or specific management variables as well. You know, all these are factors that at the end of the day will determine whether a company is doing well or is not doing so well. And if the company is doing well, it will reflect in its financial reports. This is what investors, stockbrokers use to analyze how strong a company is. And that's what makes investors to decide to buy a stock or to sell a stock. If you are doing very well, they want to buy because they want to be a part of your future growth. If a company that's going downhill, a lot of people would like to get off the bus and to show from your financial report.
Okay, since you've already started talking about companies, now when you go on the Nigerian Stock Exchange platform, you'd see different companies listed, but then you'd also see a variation in the cost of their shares. So you see company A, the value of their share is higher than, say, company B, and then the value of the share of company B may be higher than the value of... What are the factors that determine the value of shares in different companies? Okay,
so two things we need to explain here. The first is that the nominal price of a stock is not necessarily the value of that stock.
When you say nominal price of a stock,
so let's give an example. First, FBN Holdings today is trading at 7 naira 50 kobo, for argument's sake. And another company is trading at 100 naira per stock. It doesn't mean that the stock that has a 100 naira price is better than the stock that has a 7 naira 50 kobo price. That is not value. That is just share price. Okay. When you're talking about value, you look at a number of variables. The returns. Okay, what is the dividend yield, for example? What do we mean by dividend yield? We mean that if you are buying a stock for 10 naira and at the end of the year, they pay you dividend of 1 naira. That means the dividend yield is 10%, 1/10. It is better than a company that the stock price is 100 naira, and they are paying you a dividend of 5 naira. Okay, because that one, the return, the dividend yield is 5%. So even though they are paying you 5 naira, which is more than 1 naira, it is not as good as the one that is paying you 1 naira, because the cost of acquiring that stock is different. So that's how we determine
so
the
when
value.
you start considering accumulated yield, you realize that the one that had a lower price for its stock, it's higher than
it may be higher, maybe higher. So I'm just saying that the share prices you see are just what they are, share prices. They're just indications. For you to know whether the value of a stock is better than the next stock, then you now do some analysis. You try to find the gearing ratio, the profits ratio, the dividend yield, the price to book, the price earnings ratio. Now, all these are things that are a bit technical, and that is why you need a financial advisor to allow you, to give you proper guidance so that you know which stock you're buying.
Okay, we'll take a quick break now. When we return, we'll talk about the bullish and the bearish trades. We'll be back. Welcome back. In terms of when I read the stock market reports every day, some of my friends just raise their brows like, what is she talking about? Today I'm saying the market was bullish, tomorrow I'm saying the market was bearish. Help them understand, please.
Okay, thank you very much. So when you talk about the market being bullish, I mean, bullish reflects the animal, the bull. And in most stock markets, you try to see a charging bull at the entrance of the market. I mean, if you go to India, if you even go to the Nigerian Stock Exchange, you see a charging bull. If you go to the New York Stock Exchange, you will see the charging bull. Now, the charging bull represents the aggressiveness, the power that we're expecting from a stock exchange. So when things are good, it means the bull is charging. So when the stock market is rising, when the prices are going up, people are happy, people want to invest more and more, they are bidding to buy, then you say the market is bullish. Okay, so it just means a positive slant to the market's performance. When it's performing well, then the market is bullish. That is the term we use. When it is bearish, just like a bear, I mean, people believe that a bear does not necessarily signify a positive sign, so it's negative. So when you say stock market is becoming bearish, it means the prices are going down, the all-share index is losing value, people are selling, there's blood on the streets.
Help them understand what an all-share index is as well.
I will do that. I will do that. You know, so when a lot of people are selling their shares, and there's more supply in the market, then the share prices will be going down. Then we now say the market is bearish. Okay, and there will be times when the stock markets at the beginning of the day will be the same price as at the end of the day. Then we'll say the market is flat. So those are usually the three terms we use. Being bullish, market is flat, or market is bearish. Now, when we talk about the all-share index, because there are many stocks listed on the Nigerian Stock Exchange, for example, we try to find a common denominator, you know, to determine how do we analyze the performance of the market as a whole. Because there will be some stocks that will perform very well, there will be some stocks that will lose their prices or value during the course of trading, there will be some that will not move. So the aggregation of all of this, you know, which we do through some calculations, is what we call the all-share index. So that gives more like a summary of the performance of the total stocks listed on the market on a particular day. So the all-share index today is around 30,000. I mean, there will have been a base year, which will have been tracking every single day. You know, so when the market is bullish or it's performing positively, the value will go up, or higher, higher, higher. Then when the market is not doing very well, when all the big companies are losing their share prices, then the value will go down. The ones they call
the blue chip companies mainly, right?
The blue chip companies are, we call them, those are usually the cream de la cream, the best in terms of analysis. You know, they have a good brand, they have good management, they have a good story to tell. You know, so the few companies, like we call them blue chip companies, you know, and they are usually the sought after stocks. So a lot of people would like to buy them because they believe in the company. The brand is strong, the management is strong, the board, corporate governance is strong. So anybody putting their money in such a stock will know that they are doing something that is nice. They are investing for their future.
And companies like that, is it in all cases that you find out that their stock prices are higher than the others, or they can still be, you know, low?
Well, in terms of prices, yeah, no. Their prices could be 10 naira, and there could be some other stocks that their prices are 1,000 naira, 500 naira. You know, so the blue chip is a bit subjective. The closest objective analysis you have is what the Nigerian Stock Exchange has done, which is to create what is called a premium board. Now, a premium board on the Nigerian Stock Exchange asks companies that have gone through a lot of iterations, a lot of review, corporate governance, their compliance with all the rules of the exchange, their positions in the market, you know. So you have very few companies that belong to that elite club of being on the premium board, while all the other companies are on the board, on the main board, you know. So if you could try and invest in those companies on the premium board, perhaps they will largely perform better than those on the main board.
Okay, and how do you determine a company that is overvalued and a company that is undervalued?
There are several ways of determining that. I mean, being overvalued means that, hey, the share price that that the stock is trading today, the likelihood of it going higher is remote. Okay, it's more likely that this stock will lose value than enhance its value. And when you say stock is undervalued, that means there's a bargain out there that people have not seen. The company is doing very well, but maybe they've not been they've not been in the public domain. People don't know much about them.
So it's good to just jump in and buy as many
at that time when it's when it's in a bargain position. So those are the ones. So how do you now know when a company is overvalued? You have a lot of metrics. The basic metrics that any stockbroker will tell you will be: one, you need to find the price earnings ratio. You need to know the book value of such a company, the price to book, you know, and of course you still check the profitability ratings.
So the fact that a company is very popular and everywhere does not mean that the book value and profitability is at its peak and its best.
So some companies could be very aggressive in the market in terms of branding, publicity, but if you check the numbers, you find out that, hey, this company is really, really not as strong as it should be.
All right. Yeah. And also, when you talk about stocks, I know that you can either trade or you just keep accumulating stocks of a particular company. What exactly are the pros and cons of either deciding to trade or you just keep accumulating? Okay.
So,
what would you advise?
As an investor, you need to understand the reason why you are making an investment. That is a fundamental reason. Before you come in, you don't just join the bandwagon and buy stocks.
Because you want to say you bought stocks.
No, you don't do that. You must have a reason. What is your reason? Is it a strategic reason? Do you want to be on the board of such a company? You want to buy enough to be the topmost shareholder in the company? Are you just buying it because you want to have money for your retirement and you just need stocks that will be paying you sizable dividend? Or you are just the aggressive type? You just want to take high risks? You know, so those are some of the reasons why you go into investments. And there are different criteria. I mean, there are different types of strategies you adopt, whether you want to accumulate. So if you are someone that your goal is, this company, I've analyzed it, I want to be the CEO of the company in 5 years' time. And the only way is for me to be on the board. The way of getting on the board is for me to own 11% of the shareholding.
No, yeah, strategically.
That's a strategic decision. So you accumulate. You find out whoever is selling, you buy. You buy. So when you're buying, your price of buying may not be so important as to the fact that you want to achieve a particular shareholding structure. So you can buy at a higher price than another person. If your goal is you think the company is going to do well in the next 6 months and the share price will go higher, then you are buying, and when you think you've achieved your goal, you sell off. Those are more like transactional or just an aggressive trader. You know, you can even buy today and sell tomorrow. Because once you've seen an appreciation, you've earned 10%, 15%, you sell. Then, so those are the reasons you can buy to accumulate if you have a strategic view that you want to be in the company for the longer haul. So when the company is doing well, when it's doing so badly, you still be an holder. But if you are just there for the money, for the profit in the short term,
Once
the company starts performing poorly, you sell and you get out.
And I feel like when it comes to trading on the stock market, right, it's better when you know that you're in it for the long haul and not just, you want to get into there and then in the next 2 months you're gone. What's your take on that?
It's a function of your risk profile and your reason for being in that stock. So if you are the type that is not interested in short-term gains, then you can be there in the long haul. You're more likely going to make some money, even though there will be times when the market will come down on you, but you have to have the staying power. But if you are not the conservative type, I mean, once you see a sign of something happening, then you exit. So what is good for someone might not be good for the next person.
All right, thank you very much for joining us on the program. And that would be all on the program for today. Let's call it a wrap. And until next time, I am Irene Ubani. Bye.